Good morning or good afternoon. My name is John Phelan. I'm an economist with the Center for the American Experiment, a think tank based here in Minnesota. I'd like to welcome you for joining us today to discuss inflation. With me to do most of the kind of thinking and talking, I hope, is Chris Phelan. No relation. He is currently professor of economics at the University of Minnesota, and he's an advisor to the research department of the Federal Reserve Bank of Minneapolis. Served in various capacities with the Fed of Minneapolis since 1998, and he's taught economics at Northwestern University and the University of Wisconsin-Madison. So, Chris, it's great to have you here.
It's always wonderful to be here. I think this is the second one of these things I've done.
It is, yeah. So it's great. It's a really good way to kind of reach people who wouldn't necessarily be able to come to an in-person event. I think we've got some people from around the world tuning in today, so welcome everybody. Obviously, as I say, the topic today is going to be inflation, and there's a real reason we're talking about this, is that inflation is in the news again. For a long time, inflation was something that people thought had kind of gone away. The central bankers like Alan Greenspan and whatnot were considered masters of the universe. We had low inflationary growth for a good period of time, but now we're back. And in the year up to December, we actually had the fastest year-over-year growth of the consumer price index at 7.0% since mid-1982. You've basically got to be about 50 years old to remember inflation like this. Just to give you put that into some context, I ran up some facts. I'm not old enough to remember mid-1982, much though I might look it. In 1982, and this is how long ago it was, the Minnesota Twins under Billy Gardner were playing their first season at the Metrodome and were on their way to losing more than 100 games for the first time since moving to the city in 1961. It was the same year that the Minnesota North Stars drafted Brian Bellows. It was the Ford Escort was the best-selling car in America. Glowworms were the best-selling toy in America. People were wearing what were called statement patterns, exaggerated sleeves, broad power shoulders, vibrant colors, and oversized costume jewelry. So if you think of Alexis in Dynasty, that kind of thing. And also, the last time inflation was this high, Stevie Wonder and Paul McCartney were number one with Ebony and Ivory. So, perhaps not as glamorous as Stevie Wonder and Paul McCartney.
It's the worst song that either of them did.
Yeah, it's not a great one, but that just gives you, the past is a different country. They do things differently there, as LP Hartley said. So like I say, I think that puts today's current inflation into some perspective, just how rare this has been. I wondered, Professor, if you had any comments on that, just how unusual it is what we're going through in a historical span.
Well, I'm not sure. Maybe what was unusual was the span from 1982 to 2022 or 2021 of very low inflation. So one of the facts about inflation across the world, across time, is an extremely high correlation between high inflation and variable inflation. So when you tend to have inflation low, any place, any time period, it tends also to be not very volatile. And so we had a wonderful record of inflation for, gotta count on my fingers, four decades almost, of not only low inflation, but pretty predictable inflation. It was always around 2%. I mean, I remember policy discussions where we're saying, gosh, we keep saying we want it to be 2%. We did want it to be 2%. And it's always turning out to be 1.7 or 1.8. And even at the time, I was saying, guys, this is not rock. We should not be talking as we're trying to manage inflation with a decimal point. I mean, there are things that you can control with 5 decimal points, and there's things that you shouldn't. Inflation is not one of these things that can be controlled to the point where you say, 2.1, boy, we were really looking for 2.2. It's not that kind of an endeavor. but yeah, it wasn't just the United States. The developed world had a remarkable record of inflation for 40 years. And it was something not to take for granted, uh,
Hmm.
because these little green pieces of paper, or options to have someone deliver you little green pieces of paper whenever you want, which is what a bank account is, are inherently backed by nothing. And we should be constantly cognizant of the fact that maintaining their value is the central job of any central bank anywhere.
Yeah, it's a very good point. It is interesting, as you say, to note that we've had this long period, and that it was not just the United States that had a good period of inflation. My home country, the United Kingdom, we had a terrible situation with inflation in the 1970s. Much like here, we had, inflation came down, recession in the early 1980s, and then things kind of chugged along. We had a bit of a kind of flare up in the late 1980s, but for a long time we had a similar sort of situation. It's worth noting as well that this rise in inflation that we have in America at the moment is being seen in other countries. So Eurozone inflation's a bit up. I just read, the UK's inflation is at nearly 30-year high now. But what's interesting actually is if you compare US inflation to all these other countries or other monetary authorities that are having these rates of inflation, as is actually higher. So, it's not just, we can't just shrug our shoulders and say, oh, well, that's everywhere. What are you going to do? There is something particular here that's making inflation worse than it is in, say, the Eurozone or the United Kingdom.
Absolutely. You
Well, the
can't.
first thing I suppose we're going to kind of get into, well, what's causing this, and then we'll look at, what things that we can do about that, how things might play out. But before you get into things that do cause inflation, it'd be kind of useful, I think, to discuss some of the things that don't cause it, some kind of popular whipping boys. One of those at the moment is corporate greed. Elizabeth Warren's a big one for this. Big meat, big grocery, big this, big that, and the other, apparently, or hoarding massive amounts of cash and driving prices up. I think that's an absolutely useless explanation for inflation. I'm sure you can put it a lot more sensibly than I can. What do you think of the idea that corporate greed is driving inflation?
So one of the things that we try to teach our students, especially our graduate students, if you're trying to explain a change, you have to, and by the way, this is not just economics, this is almost everything. If you're trying to explain a change, you have to explain it with a change.
Hmm.
So one of the things so we had a change. We had almost 40 years of hardly any inflation, and then 7%, which is a big one. In order to get the change from hardly any inflation to 7% inflation, you have to say, okay, what's different? So it's not just the case that you have to say, oh, it's greedy corporations. It would have to be greedier
Yeah.
corporations. My default is, heck, it's probably a fiduciary responsibility for a corporate leader to be greedy. That's your job. Your work, there are people who hire you to make money for the company that they own the stock of. So my default assumption is that they're always greedy and trying to make money. The question is there any evidence whatsoever that they're greedier now than they were 10 years ago? If there is, I haven't seen it. One of the explanations that I've seen is, maybe I'm stepping on your toes here, you would have brought it up, is increased cartelization. So maybe when you say big meat, you're thinking that this is an oligopoly that somehow has the ability to raise prices. But again, if you're going to try to explain a change, you need to explain it with a change. There's not a heck of a lot of evidence that suddenly the meat industry got more concentrated than it used to be, or the oil or gasoline got more concentrated than it used to be. So yeah, none of that works. Here's one I saw the other way. When inflation was really low, especially when we were increasing the money supply like crazy and it was staying low, one of the explanations was the internet.
Mm.
It's easier to search for prices. It's easier to search for low prices, and that makes it harder for companies to raise their prices. That might work for a small change, for a short period of time. But this idea that you're not going to get inflation because of the ability to search, it is true that if you can't search easily for a low price, that will tend to cause a high price. But inflation is not a high price. Inflation is increasing prices. And
Yeah.
so, no, none of these things are going to explain month after month after month after month after month increases in prices. Uh, Only something that's going up month after month after month after month tends to explain something that tends to do that.
Absolutely, yeah. Another thing as well that I hear a lot is people say, well, oil prices are going up. This was a popular thing in the 70s when there was inflation in the US. People kind of blamed OPEC for yanking up oil prices. I know that Milton Friedman, for example, pushed back against that, but we hear a lot about it now. Like I say, meat prices are one of these things. We have billboards up, and I believe you can see one from your office window, which talks about gas prices and highest inflation. Now, these prices might be examples of something, but could you explain why individual price rises are not inflation, and why the rise of this price or that price does not cause inflation?
You can't get inflation because what inflation really is it's difficult to talk about the value of a dollar because a dollar is worth a dollar. And the problem is the language which we use to discuss prices is that Diet Coke, $1.50. Sorry, it's $1.50 per Coke, but the price is in terms of dollars. The price of a Toyota Corolla is in terms of dollars. So when you can easily see changes in the price of a Toyota Corolla by just looking at how it's changing in terms of dollars. The problem is if you're trying to figure out what's happening to the value of the dollar, well, it's always one. Well, you can compare it to British pounds. You compare it to euros, Japanese yen. You can compare it to houses. You compare it to stocks. All right, but which one you compare it to see the change in the value is always a tricky thing. So the typical way that we measure inflation, and really it's a measure of what's happening to the value of the dollar, is the consumer price index is, we call it a basket, which is what does the typical person spend his money on? And it's this much rent, this much food, this much cars, this much gasoline. And they just figure out the market basket of the mythical typical person and track what's happened to the price of the entire basket over time. And that's the thing that went up 7%. That's what it means for the consumer price index to have gone up 7%. The price of that basket went up. In normal times, it's always the case. Some prices go up. And in non-inflationary environments, some prices go up, some prices go down. The price of the basket stays about the same. So you can't, this idea that, oh, it went up because this price went up is not a good explanation because it's always the case that some prices are going up. What's different about inflation versus normal times is other prices aren't coming down enough to make up for it.
Yeah, one thing that I remember Friedman saying about particularly the oil shocks in the 70s, was that if the price of oil goes up, so you've got a fixed amount of money to spend on things, on your basket of goods. If the price of one goes up, you spend more of if you want to maintain the same level of consumption of that good, you have to spend more of your money on that. But that means you have to spend less of your money on other things. So those other prices have to come down to offset the rising price of the one thing, oil in that case, which goes up. In actual fact, what he said is the only way you can get this general rise in prices is if the amount of dollars you have expands to accommodate that. Which is, I suppose this is the same thing we hear about wage price spirals as well. That's the big concern. People now are saying this is all going to feed through into higher wages. So what do you think about that? Is that a slightly different thing to particular price? Or is it the same?
It's the same thing. You can't get this, this price goes up, so everyone else has to raise their prices, so everyone else has to raise their prices, everyone else has to raise their prices. That kind of logic, it sounds good at first. By the way, this is why there's math on the board behind me. All right. One of the things that makes economics hard is I always say economics is basically about two things: incentives matter, and everything has to add up. And what you're getting at is the latter. All right. Everything, if you actually try to to carefully account for the fact that everything has to add up, you can't get these inflations in everything just by starting, well, one price went up, so that raised everybody else's cost, because you're going to run out of money. That's the thing that doesn't add up. So what tends to happen, like what happened in the 70s, was, yes, there was the OPEC cartelization. So oil wasn't cartelized before. Due to something going on with one of the Middle Eastern wars, OPEC was formed. They cramped down on oil supplies like crazy. Oil prices shot up worldwide. The reaction of most central banks was to say, oh no, this is going to tank the economy. Let's start printing money.
Yeah.
It's the printing money that allows the thing that you were saying would otherwise cause other prices to go down, which is, if you're spending more money on your oil, and there's not more money, you got to spend less on something else, unless the Fed or the other central banks of the world start the printing presses going. Then you don't have to set everything. You don't have to lower things than everyone else. I'll just put it somewhat like this. I don't know of a historical episode of significant inflation that was not also accompanied by significant money creation. I do know of the opposite. Like, for instance, around the financial crisis of 2008, we were printing a lot of money and there was not significant inflation. We can get into that. But if you see inflation, it is accompanied by money growth.
Okay, that's a good kind of lead into my next point. Actually, we've talked about things that don't cause inflation, so now we talk a little bit about some that do. I just kind of go with this quote here. This is a quote you often hear in truncated form, and I think you lose a lot from that. But here it is. It's Milton Friedman. He famously said, "Inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output." I think that if you look at the numbers, that is a fairly good explanation of why we've seen what we've seen recently. So that if you look at, just to throw some numbers out there, from the fourth quarter of 2019 to the third quarter of 2021, real GDP or output increased by 1.4%. Of course, you've got the pandemic doing that, and then it kind of bounces back up and then recovery slows down. But over the same period, from December 2019 to November 2021, the amount of money on the M2 measure has increased by 39.9%. So we've had a huge increase in the stock of money relative to the amount of things it can be spent on. So do you think that shows that Friedman is correct in this instance?
Well, what's funny about what Friedman said is he won a Nobel Prize. He's a fantastic economist, which is, to his credit, he was a public economist, but also an academic economist. So a lot of times when you see, Bill Nye the Science Guy is actually not doing science. Right? Whereas Milton Friedman was actually an academic economist doing real stuff, but then also was very good at talking to the public. I'm basically stealing from him when I said, whenever you see inflation, you got to look for the money growth because it's going to be there. You notice he didn't say it the other way around. He didn't say money growth always causes inflation. He said inflation is always caused by money growth. So he's right. Now, the thing about the 39% increase in M2, there has been, the problem with academic economists, and we consider this to be a big puzzle over this 40-year period, was the correlation between money growth and price growth was not as tight as one would have expected. We increased there were a lot of inflation hawks saying that the sky is going to fall down in 2009 because we were increasing the money supply like crazy, and then it didn't happen. The inflation didn't happen, and so those guys, I think, they shouldn't have lost credibility, but they were seen to have lost credibility. They said the sky was going to fall, and then it didn't. The way I would put it, so part of me, and that's again the math on the board back there that you can't see, is the relationship between money growth and inflation is always tricky. It's like I said, if you see inflation, it's probably got money growth behind it, but if you see money growth, you might not always get inflation. And that's because at very low interest rates, which we've had, if nobody expects inflation to happen, you're going to get very low interest rates. And at very low interest rates, people are basically willing to hold whatever money the Fed puts out. They're not going to necessarily go spend it and drive up prices, because if putting it, I leave it in the bank account, I get nothing.
Yeah.
I buy government bonds, I get nothing. I buy corporate bonds, I get close to nothing. All right, so I might as well just leave it in the bank. Whereas if inflation's 10%, so nominal interest rates are 12%, people are not leaving their money in the bank. But the way not to leave your money in the bank is you go buy something. And if you go buy something, you're driving up prices. So there is an always worrisome self-fulfilling prophecy type thing with inflation. If people think that there's going to be inflation, they don't want to hold the money. And if they don't want to hold the money, they go buy things, because that's how you not hold money. And when you go buy things, that drives up prices. I think that's what's happening now. And the way to get rid of it, well, we'll talk about that later.
Yeah, the point about 2009 is an interesting one. I was doing my undergrad at the time, and I was one of the people who did think that we were in for much higher inflation than we actually saw. And if I look back now, the numbers for the US and the UK are substantially similar. In both cases, you had a very large increase in the monetary base, which is what broader measures kind of pyramid off of. And I thought that would lead through to a proportional increase in a broader measure. But what happened in 2009, really, I think you see, is that this monetary base was expanded by the Bank of England or the Federal Reserve, and this new money was used to buy assets from financial institutions, which had just been rinsed by the collapse of collateralized debt obligations. And that money just kind of sat in banks. They then didn't use it to loan out and expand broader measures like M2. And I think that's what people like me missed at the time. And since then, and I think this is why it's an important point to revisit, I've heard lots of people say, well, we should just print more money to pay for this or to pay for that or to pay for something else. And when you say, well, that's going to be inflationary, they say, well, it wasn't in 2009 or through to 2014. But that's a different thing, it seems to me. If you're printing up money and then giving it to somebody who just sits on it, that's not inflationary. If you print up money and then it gets loaned out by, or a bank uses it to expand the broader measure of the money supply, or somebody spends it, then that will be inflationary. It seems to me that there's a big difference between the previous monetary expansion and this one.
Yeah, and I think a colleague of mine, Marco Bassetto, and I wrote about this a few years ago, and I hope our prophecies don't turn out to be true. It'll help my career if they do, but it will hurt the economy, which was it's a dangerous thing to increase the money supply in the hope that the banks just sit on it, because whether they sit on it or not is now no longer control of the central bank. It's up to the banks. And whether they sit on it or not, in some sense, depends on what they think the other banks are going to do. If they think all the other banks are going to sit on it, then sitting on it is a fine thing to do because it's not going to be inflationary. If they think that all the other banks are going to loan out those, are going to use it to expand their loan portfolios, then that's going to cause inflation, which means me sitting on it is a bad thing to do. So I do think and we were warning that it's essentially dangerous to have this huge amount of what we call the Fed balance sheet. But we'll see. And, it is still possible that, so the one thing I would like to say to anyone in the audience is if someone tells you with extreme confidence that they know what's going to happen to inflation, they're a fraud. All right, there's another Milton Friedman quote, which is, if anything, I'm doing this from memory, I wish I had it in front of me. If anything, the economists' track record when it comes to prediction should give us nothing but humility. We're just not that good at predicting. We have good theoretical reasons why we're not good at predicting the stock market or whether or not there's going to be a recession. The idea is if everybody knew a recession was coming, it would already be here. But inflation is just more of an empirical thing. We're not that good at predicting inflation. Every time it comes, it's a surprise. Usually the best guess of what inflation is going to be is what it is now. You could make a prediction model that does slightly better than that, but not much. It's just a very persistent variable. 2% inflation tends to be followed by 2% inflation. 10% inflation tends to be followed by 10% inflation.
Yeah, I've written about this on our website and in the recent magazine. I've got an op-ed in the Pioneer Press, I think, next couple of days about this, where it's what I did is I reconstructed one of Friedman's old charts that shows money divided by unit of output on one line and the CPI on the other. It kind of changes and logarithmic scales and all the rest of it. But what it basically shows is a relationship that's incredibly close up until Friedman started writing about it. Which is, if that's Goodhart's law in action or what. But it's still fairly close since then. It's still a fairly tight relationship until the last 18 months, 2 years or so, since the pandemic hit, when you really do see a stark jump in the amount of money per unit of output. And that is driven, obviously, partly by the collapse in output, which has now been kind of made up. But the growth rate of money still continues. The M2 money stock monthly is still increasing at double-digit rates. And all this comes about as in 2009. We've got a massive expansion of the monetary base. Just throw some more numbers out there. Between December 2019 and November 2021, the monetary base expanded by 86.6%. So the Fed printed up all this money and then it used it to buy financial assets from financial institutions. So that its balance sheet has increased by 110% over that same period. And that is now feeding through into these broader monetary measures. And it seems to me that what you're saying is that they need to stop that. They need to stop printing up this money and buying these assets. Would that be correct?
I guess I'd put a little bit more nuance on that, but more or less that's it. The correlation between money growth and price growth, inflation, isn't 100%, but it's high. Especially if you're willing to average enough over time. All right, so you're not going to be able to do this forever. If you could just print money and not get inflation, then we should just stop taxing. Just forget it. Cut all the taxes to zero. We've got to, spend 7-8 trillion. I don't know what the exact number for the governments, all the governments are of the United States, by state, local, federal. But just print the money and do that, and don't, if you don't have to worry inflation, just do that. Well, that's obviously wrong. All right, so it is true, though. It is true that you can't do that without getting inflation. What's not true is that in the short run, if you increase money growth by 3%, then you're going to get 3% inflation. So the relationship is absolutely there. It's just not that tight month to month, year to year. But it is pretty tight if you're willing to do, like I'm looking for I'm going to see if I can get this up here. I'm looking for a particular graph. Now, the graph is a little bit old up. I just messed it up. I'll find it later. I'm going to get rid of my share for a second. If you just look at 10-year averages of money growth for countries and 10-year averages of inflation for countries and plot it, you get a 45-degree line. You're not getting Zimbabwe with, billion% inflation because, oh my gosh, it just happened. All right, they were printing money like crazy. During the hyperinflations of Germany, It didn't just happen. They're printing money like crazy. When Venezuela has hyperinflation, it's because they're printing money like crazy. So yeah, it is the case that you're not going to get. So if it's the case that you're not going to get a lot of inflation without printing a lot of money, then yes, it does seem to be the case that either you need to stop printing money or convince people that you're not going to be printing it for much longer. That will also do it. The
Yeah.
problem is that we are using most of the money that's being printed is being used to buy government debt. And most of the government debt is being bought by the Fed. So I guess the worry is that if the Fed stops buying government debt or stops buying so much government debt, then that will reduce the demand for government debt that have to be bought up by the rest of the players in the economy. When one of the major buyers drops out, when it's anything, that tends to cause the price of the thing to go down. But if government debt auctions off for lower prices, that's just another way of saying that the interest rate associated with that debt is higher.
Yeah.
Causes interest rates to go up. And once you have that, we got $30 trillion in debt, right? Even 1% of, a 1% increase in how much you're having to pay to service $30 trillion in debt is serious money, even if you're talking about the United States federal government. If interest rates go even higher, then we're really talking about a lot of money that the federal government is going to owe on debt. And so the worry is the Fed going to be willing to go through the pain associated with not printing so much money?
Yeah, I used to use the phrase that the Fed had kind of printed itself into a corner. It's difficult to see how they kind of exit where they've been for the last however many years. And if we go back to 1982, the inflation numbers that we had back then were on the way down from peaks, in 1979, 1980 or so, because you had back then Paul Volcker, clamping down on all this, interest rates going up, and people who are old enough may remember double-digit, interest rates, Fed funds rates, and things like that. So that's kind of what we're talking about, I suppose. Perhaps something like that. That kind of economic pain. One thing I think people get mixed up sometimes when you talk about this is they say that the economic pain, in terms of lost output and lower employment, is the way that you reduce inflation, rather than a kind of side effect of what you are doing to reduce inflation, which is cutting back on the money growth.
I think that's right. Let me just see if I can share this screen again. I just want to get across. Does this show up?
Yes.
All this chart is, and this is by a colleague of mine, Warren Weber. Every dot is a country decade. It's some countries' experience where the x-axis is how much money growth was in that decade, and the y-axis is how much inflation was in that decade. So every dot is a country decade. And they pretty much, at least for higher inflations, are all pretty close to the 45-degree line, which means that their inflation was pretty close to what their money growth was. The clump of dots towards the left is lower inflation, lower money growth countries. And you can see that the correlation is not so high there.
Yeah.
But it's nevertheless, this is about as good as you get in economics in terms of a correlation. If you want to see, if you've got a high inflation country, it's because there's high money growth. If you have a medium inflation country, and there we're talking 50% a year in this graph, it's because you got 50% money growth. So in some sense, yes, if you see really high inflation, by the way, 7% is high, but it's nothing like we can see in the world. I mean, the countries where they measure the inflation rate per week, what's the percent per week in inflation? And that can happen. But it can't happen unless you're printing money like crazy.
Yeah. I've tangled with modern monetary theorists on this before, who one of them argued that the inflation that they saw in Zimbabwe a few years ago was nothing to do with money creation. It was all down to a failure of the Zimbabwean government to collect enough tax revenue, was one. And another was that their economy collapsed, and apparently that made inflation go
Well,
up.
I always say the following about modern monetary theorists, which is they're not as crazy as they sound. They're still crazy. All right? They're just not as crazy as they sound. Some of what they say actually makes sense. It just doesn't all, when you add it up, make sense.
Mm.
So that's what I mean by they're not as crazy as they sound, but they're still crazy. Because the logical argument, if you take what they say to the logical extreme, we really shouldn't be taxing. We should
Yeah.
just be spending money on everything. So that business about the problem, there's a very famous article from the Minneapolis Fed called Some Unpleasant Monetarist Arithmetic from I believe it's from the 1980s, by Neil Wallace, Tom Sargent and Neil Wallace. And what it basically said is that there is a dance between the fiscal side, like the treasury of a country, and the money side, like the central bank or the Fed of a country, which it's like a game of chicken, which is if the fiscal side just says, look, we're going to spend and we're not going to tax, driving towards the cliff. What are you going to do about it? To the money side, a lot of times it's the money side that will blink or put the brake, do the, be the one that in the game of chicken loses, which is say, okay, fine. Then somebody's got to buy the debt, we'll buy it, which means that they increase the money supply. So it is true. If you want to know, imagine you're a dictator and you're not very good at collecting taxes because nobody's paying their taxes. You got to pay the army or they'll kill you, right? And so you just pay the army. Where do you get the money? You print it. So this is what I mean by the modern monetary theorists are not completely crazy. Well, they are, but they're not everything they say makes no sense. The fact that Zimbabwe couldn't collect taxes actually is part of the answer. They need to pay the army.
Yeah.
And so that doesn't mean that they didn't print money, though. They printed money because they needed to pay the army. You're always going to see the money creation there. What the modern monetary theorists are doing is, I always consider this like the Japan puzzle. So here's an example of a country that has been printing money like crazy for 30 years and not getting inflation, which is Japan. And it is because interest rates are really low. And if interest rates are really low, we don't even know how much. We know that it has to stop at some point. You can't have private holdings of cash go to infinity, but we don't actually know exactly how high they can go. And Japan seems to be testing this. We have $30 trillion of GDP and a $21 trillion economy. Their debt is even higher relative to their GDP, and they just keep doing it. And they just keep monetizing it. They just keep having the central bank buy it. What modern monetary theory is kind of, okay, well, let's just assume we can do this forever. Well, you can't. There's just no way you can do this forever. That doesn't mean you can't do it for a while.
Yeah. I read Stephanie Kelton's book, The Deficit Myth, and it starts from something that's incontestably true, which is that a monetary sovereign need never go bankrupt because they can always just print the money to pay their debts, which I don't know anybody who thinks that, who doesn't kind of acknowledge that. I think everyone kind of knows that, but that's the big insight. They kind of spin from that into, well, you never need to worry about going bankrupt, which is kind of crazy because you can default in real or nominal terms. And I always think
Absolutely.
that modern monetary theory, it boils down to, you don't need to worry about turning into Greece because a monetary sovereign can turn itself into Zimbabwe instead, which is
That's a good way to put it.
Not a particularly.
No, it's true. It's true that Greece cannot monetize its debt. It can't simply just print money to pay its debt because it doesn't have the legal authority to print euros because it's in the Eurozone. When it had drachmas and it had its own central bank, then yes, when it's time to pay its bills, it could just print money and go here. So they're absolutely right that if you control your own currency, that there's no way that your central bank can go bankrupt.
Yeah.
You can't simultaneously control your own currency and have low inflation and keep the value of the currency up and not go bankrupt, because it might be the only way you can keep from going bankrupt is to pay the debt by printing new money. And at that point, all bets are off on whether you're maintaining the value of the currency.
Yeah. Well, we talked a little bit about what the Fed has done over this period in terms of expanding the monetary base, buying assets and whatnot. Here's a question for you. Do you think that that was the right thing to do? Do you think the Fed has done the right thing over the course of this pandemic?
In some sense, what you have to do to judge them on is how well things were going. So the fact, before we had 7% inflation, I think was, then look, at some point, 40 years of 2% inflation. I know there's somebody in the comments saying, well, why 2%? Why not zero? But frankly, across the world and across history, I don't care. 2% is not that far from zero, right? And I'm happy with 1 to 2%, but I don't really think it matters that much of whether we're talking 0, 1, or 2%. So in some sense, the fact that they were able to maintain predictable low inflation is just plain, they should have spiked the football and done a little touchdown dance. The fact that it's 7% now seems to be an indication that, you're not doing well. So I guess I would ask them to be judged like any other government created entity to be judged, which is, are you doing your mandate? So their mandate is low and stable inflation. It's also full employment and financial stability. I'm a little worried about them having too many mandates. But by their mandate, low and stable inflation, they did remarkably well over 40 years. And they're not doing well right now.
Yeah, I mean, to what extent do you think, this is an interesting point to touch on, slightly off topic, but to what extent do you think the Fed gets distracted? Because it has this dual mandate, of inflation and unemployment, which is a tricky one because there isn't really a trade-off. We've been told that the old Phillips Curve trade-off doesn't really exist in much beyond the very short term, if it exists then at all, it seems. So do you think that the Fed could get, or is being distracted by other things? Instead of focusing on price stability, it's factoring various other goals into the thing now.
Yeah, that bothers me. I always want everyone to stay in their lane. You have one job, and you say it's two jobs, but I agree. And this is where I'm only speaking for myself here. Well, by the way, this whole time I'm not speaking for the Federal Reserve Bank of Minneapolis. Every opinion here is my own. And only my own. The dual mandate I like to interpret as the way you get full employment, the way you get a good functioning economy is through low and stable inflation. So just worry about the first one. The second one will follow. You're right. It might be the case that you can very temporarily move towards more employment by moving on, by allowing there to be a little more inflation. It's not worth worrying about. You should just keep your eye on one thing. And yes, it is absolutely true that the Fed starts worrying about equitable stuff. I seem to be on a lot of issues that are not in its tool set. I mean, poverty is a problem in the United States, but the Fed gets to decide how much money to print. And I see there is a question about what do you mean by printing money? When the Fed buys anything, when I buy something, let's say I buy your car, John, my bank account goes down, your bank account goes up, and the car goes over to my place. The amount of money in the system doesn't change. If the Fed buys my car, I don't know, maybe to have one of their inspectors drive around in, it's not the case that they just increase the amount of money in my bank account, and that's it.
Yeah.
There's no other bank account that's going down. That's what I mean by printing money.
Yeah, so that's an interesting point. I know there's a discussion at the moment about a Federal Reserve Board appointee. People should go and read up about that. That kind of highlights some of these discussions. like I say, I think it's interesting. We always seem to look for somebody to fix things, it seems to me. And this is a broad range of, this goes beyond monetary policy and perhaps even economics. But I was having a discussion with somebody, a very different kind of economic and political ideas to myself recently, who said, I can't believe that the most powerful men in America can't fix X problem. And I think to myself, well, maybe they can't. Maybe with all the power they've got, they can't do it. Just the same as King Canute couldn't order the sea back from the coast of England. The Federal Reserve, with its money printer, cannot fix this problem, that problem, the other problem.
All the Fed can do is buy stuff and sell stuff. That's what it
Yeah.
does. The language that you see, oh, they decided to raise interest rates or whatever, that market is actually a relatively free market. It's the market for what's called the overnight funds rate. It's banks lending and borrowing with each other in order to make sure they have enough money in case depositors come in. Once a day or a few times a day, the Federal Reserve Bank of New York comes in and buys or sells in that market. Every time it buys something, that creates money. Every time it sells something, that destroys money. And they do that in order to try to get interest rates to be what they want it to be. So if they say they want the federal funds rate to be 0.5%, they're intervening in that market. But that's basically most of the tools that they have. They can regulate banks a little. They can change the rate at which they borrow and lend with the banks a little. But the idea that you're going to fix all the problems in the world 25 basis points at a time, it is fantasy. I mean, Milton Friedman quote after Milton Friedman quote here. I think he liked to use the analogy of oil in a car. You're not going to make a car go 200 miles an hour by making sure that it has the right oil level, but you can make it go zero.
Yeah, absolutely.
So I would say that the central bank of a country has great ability to do harm by messing up and making it very hard to get transactions going on because God knows what's going on with inflation. But you're not going to get wealth by changing the amount of little green pieces of paper you decide to print. You can screw things up, but you're not going to become a richer country through your monetary policy, other than not screwing things up.
Absolutely, yeah. It seems to be it's a lesson that we have to learn again. We learned it 40 odd years ago. I remember writing something for the 40th anniversary of Milton Friedman's talk on the role of monetary policy, which said that the Phillips Curve was a lot of nonsense that would break down. And he wrote that almost immediately before it broke down. And now you go and find people talking about, well, where's the Phillips Curve? Why can't we find the Phillips Curve? Well, the guy told you 50 years ago it doesn't exist, and he was right. So give it up. I think people are wedded to things like the Phillips Curve because it does give, Hayek talked about the pretense of knowledge, but I think there's also this pretense of power and this pretense of capability that somebody somewhere can fix all this. And we just need to identify that person and have them fix it. And that, as I say, is a problem that goes way beyond economics. We're approaching the last 10 minutes of this now, so I'm going to have a quick look through the questions and see what we have. Some of these, I'll just run through them in more or less the order that we got them. So one of them is the Taylor rule indicates rates should be 5% or higher. Do you think that the Fed will get back to that, or do you think the Fed will ignore it?
I don't have much to say on that. The only thing I'm going to say about the Taylor rule is that Taylor came up with it as a way of predicting Fed policy as opposed to what Fed policy should be. And it was later glommed on to be what Fed policy should be. I prefer to think of it as just we need, maybe very old fashioned, we need to stop buying so much. And that will have an effect on interest rates. And I don't know how high interest rates will go if we stop buying stuff to the extent necessary to control inflation.
Okay, there's a question here. It's from an anonymous attendee. It's a bit of a long one, but I'll try and boil it down. And it's really about what individuals can do. So if you're dealing with kind of inflation, what options do you have as you kind of average person? Are there particular things you can do to help yourself or to shield yourself?
Well, in general, inflation hurts you. So this is just about your own personal finances. Inflation hurts you to the extent that you hold what I'll call dollar-denominated assets. So obviously dollars are dollar denominated assets in the sense that you have 20 bucks in your wallet. Uh, Anything like a bank account. A bank account is a loan from you to the bank, and they owe you a certain amount of money, and it's denominated in dollars. ExxonMobil stock is not denominated in dollars. It's denominated in shares of ExxonMobil. And so if there's a lot of inflation, you still own the same number of shares of ExxonMobil. That's your house is not dollar denominated. Any bank account is, if somebody owes you money, it's getting devalued when there's inflation. If you owe somebody else money, you're making out like a bandit. I mean, if all of a sudden all prices went to, 1,000 times what they are now, I would get a free house. The bank would lose, but all of a sudden all this money that I owe to the bank for my house, well, guess I own the same amount of money, but it's worth 1,000. And so there's all sorts of winners and losers. But the basic idea is inflation devalues all your dollar denominated assets, which include bonds and things like that. In general, the entire idea of an independent central bank, which is actually a great idea. So an independent central bank there's a lot of money to be made making money. You can just pay your bills. That's why counterfeiting is illegal. So countries where the central bank is not independent of the treasury tend to print money more whenever they need to pay their bills, and they tend to get much worse inflation outcomes. So the whole idea of an independent Fed was to make it so that the incentive to print money goes away because you don't get to keep the profits. So the Fed has to give over its profits to the treasury. So it's not like, they get to give it to their shareholders. So there's no real incentive for them directly. There's no financial incentive for them to create a lot of inflation. The incentive is there's some kind of political pressure. You're not going to get reappointed if you raise interest rates and cause an inflation before an election or something like that. So I wouldn't say we're that independent. We're a lot more independent in places where there is no separate central bank at all. It's just the government, whoever's elected, or worse, not elected, just a dictator, just decides how much government to print, how much money to print.
Yeah, that's absolutely true. I'm just looking at, so I think we've covered a fair few of these questions, actually. We've got one, what are some signs that inflation is moderating? I suppose that would just be a decrease in the growth rate of the CPI, really, wouldn't it?
Yeah, this is what I meant about inflation not being that predictable. The best empirical predictor of inflation tends to be inflation.
Yeah.
That's why it's worrisome that when it gets up to 6%, you can't just say, oh, it's going to go down. That's not what the data have told us in the past. The data tends to say inflation is extremely persistent. So if I see 6% inflation, I don't go, oh gosh, it's going to go to 100. Or it's going to, oh, this is just going to go away. It's going to go to 1. If you completely separate this from any theoretical understanding and just say, let's look at the numbers. What the numbers tell us is 6% inflation tends to be followed by 6% inflation. So I would be a lot more comfortable about inflation if it starts to go down.
Yeah, absolutely. Like I say, just to kind of revisit the point about the central bank independence. Like I say, this is something that we learned, 40 odd years ago. It seems to me, and it's interesting. You talked about the kind of Fed model, but that model has been kind of copied. So the European Central Bank is kind of independent. The old Bundesbank was independent. And the Bank of England, that was made independent in 1997. One of the first things that the incoming Labour government did, one of the things that I thought was a good idea that they did. So this is something that we learnt was a good idea, to make a central bank independent, so that it didn't just print money, to buy votes effectively. And we seem to be kind of drifting back from that. It's an interesting point, the idea, and this is a broader question, that to the extent that we truly learn things. We learn things for a bit and then forget them and have to relearn them, it seems to me. Do you think that's a particularly truthful way of describing it?
Yeah, it worries the heck out of me constantly. I'm starting to think of various Kipling poems. But yeah, people seem to forget, basic things like there's no free lunch. Or you cannot, modern monetary theory, like I say, it's not as crazy as it sounds, but it's still incredibly crazy. The idea that that you just print your way to prosperity. If it sounds too good to be true, it is.
Yeah.
Right? And it is. And it's somehow that, yes, I'm old enough to remember, well, I obviously am old enough to remember the inflation from the 1970s, but I'm old enough to remember as a kid reading the newspaper was this thing that came and you actually had pieces of paper. And there were, Dear Abby was an advice columnist, and somebody said, why are we always worried about the deficit? Why doesn't the government just print money to pay for everything? And she said, well, I don't understand either, but economists say it would cause inflation. I remember this as a kid. And that is, kind of an amazing thing that people have to relearn, that you just can't print money. You can't print little green pieces of paper to create prosperity, which should just seem obvious.
Yeah.
That
I remember one of my undergrad lessons. It was macro theory and policy, introductory macro or something, and we were lumped in with some political science students. They said, any questions? And one of these political science students put her hand up and said, oh, why don't we just print more money and everyone will be rich that way? And all the economist students in the room, oh, what an idiot, and were laughing. But I don't know, I kind of get the idea that she get a better hearing now than she did at the time, which is kind of worrying. The real sources of prosperity are productivity growth, growth of stuff, growth of productive capacity, ideas. We seem to think that we can shortcut all that and just have some guy, press a button on a printing machine.
Yes, and I find it worrisome that has to be relearned.
Yeah. Well, that's it does worry me, I have to say. Well, we're approaching 1 o'clock. I think that's actually kind of a good place to start wrapping things up. I just got a quick question here, and I don't think anybody would forgive me if I didn't ask something about this. Something about the correlation of gold to inflation. These sorts of conversations, mentioned about gold as a monetary standard or as money often come up. Could you just give us a few quick thoughts on that?
I don't follow gold. I literally have no idea what's been going on with the price of gold recently. There's nothing magic about gold. It has a long history of being used as money because it's extremely good for money. It's hard to fake it. Even in ancient times, it was relatively easy to tell. That whole Archimedes story. Was it Archimedes the one that looked at volume displacement and weight?
I think so.
It's incredibly divisible. It can be, it makes a good money. Lately, and I think we've gotten relatively good at using fiat money that's not backed by anything. But in many senses, the reason gold historically had a very high value was because it was such a good money that people expected it to be valuable for money in the future, so they're willing to give away things for it now. So personally, I don't think there's that much difference between gold and fiat money. Because what are you going to do if it also became valueless as money, or value? You actually had to have it for use value. Then basically you can use it for jewelry because it looks nice.
Yeah.
So I'm not much of a gold bug because I think that or a Bitcoin bug, or any of the other things. The economic theorist in me sees why these things can have value, because it's always the case that these kinds of things can have value if somebody else expects to have value in the future. Somebody else expects to have value in the future ad infinitum, because then you can start using these to trade for things. Gold, I guess if you want to diversify, maybe you want to have some money in gold. For the same reason you might want to have some money in yen too.
Yeah.
Or some of your wealth in yen.
Yeah. I should stress that we're not giving out investment advice here. I get asked that all the time. So But no, anyway, well, that brings us nicely to 1 o'clock. That's a good place to finish, I think. I'd like to say once again, Professor Phelan, thank you ever so much for coming on. It's been an absolute pleasure. I've really enjoyed it. I'm sure the viewers, listeners have too, wherever they are. So yeah, thank you very much. It's been excellent.
It's always my pleasure.
Thank you very much, and thank you for everybody for tuning in. Thank you.
Thank you.